Inventory will rise and then home prices will fall. This is something I've talked about on this channel for many months now. And the markets with the most inventory are at the highest risk of seeing home prices decline across the board. We're starting to see this come to fruition as a major home builder, KB Homes, cuts prices of their new construction in four major markets across the country. Where are those markets? Well, they're the markets with the highest levels of inventory, or at least some of the highest levels. They all have more homes on the market than they did in 2019. And right now, if you've been following my videos, you know that there's fewer home buyers in the market than there were in 2019. Even though the Fed's rate cut has brought more home buyers back into the market than we've seen in recent months, there are still fewer home buyers out there than we saw in 2019. So if there's more inventory and there's less buyers, that's a recipe for home prices to come down. Now, in markets where there's less inventory than 2019, home prices are going to be more insulated. But that being said, the market that I operate in here in Vermont is a market with fewer inventory than 2019, right? There are hardly any homes on the market. Yet, what I'm seeing is in the higher price neighborhoods, sellers are more negotiable on price. I'm getting texts from listing agents in the 800,000 to a million range where I've shown property recently and they're saying, look, the seller's negotiable, bring me an offer. They'll consider any offer that you want to throw out there. And so sellers in higher price neighborhoods are feeling more pressure as there's less buyers out there who can afford those homes. That's what we're going to talk about in this video. We're going to go into some articles and show you the stats behind what's going on and why mortgage rates have actually ticked up even more since the Federal Reserve cut rates. They're now floating at around 6% for the absolute best mortgage rate you can get. And of course, the Federal Reserve, they haven't hiked their rate. We're going to talk about why that happened and why mortgage rates trended up as well. So before we get into it, my name is Liam O'Reilly. I'm a realtor with Jerry Riley Real Estate. If you have any real estate needs, either in Vermont or anywhere in the country, reach out to me directly. All of my contact information is in the description. So let's get into this first article here. This is out of Fast Company. 4 housing markets where giant builder KB Homes is cutting home prices. So we scroll down here, we see that these 4 markets, San Antonio or Austin, San Antonio, Orlando, and Jacksonville, are among the few metro housing markets where active inventory for sale has returned back to pre-pandemic levels. So we see here, they have these nice charts. This is the Austin area. We see that there's 10,000, almost 11,000 homes for sale in Austin as of August 2024. If we look back to August 2019, there were only 8,000 homes. Even August 2017, there were 8,600. So there's about 2,000 or 3,000 more homes for sale today than there was before the pandemic, right? There's more inventory. Those markets are at a higher risk of seeing home prices come down. Now we take a look here. San Antonio, same story, almost 12,000 homes for sale. We see it's well above pre-pandemic levels. Jacksonville, 8,300 homes for sale. Now it's only slightly above pre-pandemic levels, but still there's less buyers. There are fewer buyers out there in the market today than there were before the pandemic. So these markets are at a higher risk of seeing home prices decline. And we see here active inventory in Orlando, again, almost 12,000 homes. Back in 2019, there were 8,100. Again, same story there. And this map, again, this link is in the description. I encourage you to take a look at this map. So these markets up here, particularly in the Northeast and Midwest, have fewer inventory. There's fewer homes on the market than there were before the pandemic. We see Chicago has 60% fewer homes today, or fewer homes for sale today than were for sale in 2019. So these markets are much more insulated from a home price correction. Now, again, that being said, we are seeing softening in these markets, even if there's not a lot of inventory, right? There aren't many buyers out there. I know I just made a video about how home buyers are back, and home buyers are coming back amidst the Fed rate cut. But even with this increased activity, even with more showings and home buyer demand going up, mortgage applications increasing, there are still fewer home buyers out there today than there were back in 2019. Now we take a look at the net new orders of KB Homes, which they're a Fortune 1000 company. They rank 545. So this is a large company. This is a big home builder. We see their homes for sale peaked in 2004, 2005 with the run up to the great financial crisis when building was crazy. And then we see a little spike here after the pandemic. But their orders are still relatively strong across the country, right? I'm assuming these markets with low inventory levels are what's holding this company afloat. Because their margins are still pretty good. When you take a look at their margins here, Q3 2024, they have a 21% margin, which means the profit that they're making. And we see this chart here that they're still doing well. So the company's not in bad shape, which I think is a good reflection of the overall housing market, right? The overall housing market in the United States, we're not seeing home prices decline across the board, right? We track that through Redfin and Zillow and these other companies. They're not reporting a national decline in median sales price year over year. Now, monthly, it's trending sideways, if not a little bit down, but that's in line with seasonal trends. And so we're seeing that with KB Home's gross margin, where, they were losing money in 2008 when nobody was buying homes. They're still making good money right now, but they have to cut prices in the most vulnerable markets out there. And now, yes, home buyer demand has increased. Yes, mortgage rates have come down, but they have started to tick up slightly. When we take a look here at Eastrise Credit Union, again, this is where I look at mortgage rates here in Vermont. They show them on their website. So the best rate you can get, if you have the best credit score, you're a prime borrower, is 6%, according to Eastrise, out there in the housing market today for a 30-year fixed rate mortgage, right? Now, if you remember, this 6% used to be 5.75% before the Federal Reserve cut rates. Then they had their rate cut, and all of a sudden it went up to 5.85%. Now, why is it all the way up to 6? Well, Jerome Powell just spoke at a press conference here. Actually, I think this article is a little bit better. Signals that the Federal Reserve will revert to a quarter-point cut in November. So he basically spoke at a conference and said that the Federal Reserve is going to be easy, be reactive. They're in no hurry to do 250 basis point cuts right in a row. And that's not what the data says. Now, the market is reacting to that. When we take a look at bond rates today, we see that the 10-year treasury was up 6 basis points. And we have the 2-year treasury was up about the same, 6 basis points. We don't have a inversion between the 2-year and the 10-year, which means that we're likely heading into a recession, right? The 2-year and the 10-year were inverted. Now they uninverted, which typically signals a recession is imminent if we're not already in one today. Now, bond rates are trending up because the Federal Reserve said that they're going to be careful about their rate cuts, right? The bond market and the mortgage-backed security market was pricing in that the Federal Reserve was going to be aggressive because they were aggressive in September with their 50 basis point cut. And we see here with the mortgage-backed security market, the red candlestick here. And what that means is that mortgage rates likely moved up, result in higher mortgage rates for today. Now, again, that's trading off of Jerome Powell's news and what he said a couple of days ago. Now, look, Jerome Powell, I don't think he's going to come out and state that the economy is in bad shape, that they need to cut rates aggressively. I think that what they're doing now is they're testing the waters. They're seeing how the market responds to the idea of a 25 basis point cut as opposed to a 50 basis point cut. Personally, I mean, if I were to put money on it today, I would say they're going to do a 50 basis point cut, even though that's not what the market is pricing in. We have more data to come out this month and next month before the Federal Reserve's meeting in November. And depending on what that data says about the shape of the economy, that will impact how far the Federal Reserve cuts rates, whether it's 25 basis points or 50 basis points. If we experience bad news in the CPI data or the employment data, then the Federal Reserve is more likely to do a 50 basis point cut, and we're likely to see mortgage rates trend lower, again, before the Federal Reserve cuts rates. So we will have to keep watching the mortgage market. We'll have to keep watching the bond market, pay attention to what this data says, because that's going to greatly impact the housing market as we move into 2025. Again, if you're a home buyer out there, I think being on top of this data is very important for you, because it's going to let you know when is a good time to buy. When are mortgage rates lower? Are they trending down? Of course, they have ticked up recently, but I think they're going to continue to trend down throughout 2025. My view on that has not changed despite the increase in recent mortgage rates. So I hope you guys found this video helpful. Leave me a comment. Let me know what you think. Thank you so much for watching, and I'll see you in the next video.